Portfolio Builder members, thanks for joining us on our live webinar today. We'll start off with a short presentation on today's trade alert, review our portfolios, look at some of the headline news this morning, and then open up for Q&A and possibly do a demo with one of you out there who'd like me to help you build your portfolio from scratch. I'll pull up your spreadsheet, we'll talk out loud about which strategy you like the most, and then go from there. So we have quite a few people. I'll just throw a quick shout out. We got David Jones, Jerry Simone, Henry Wong, Jeff Woods, Mark Mayernick, Mike Whitley, Neil Joseph, Rep 120, Teresa Montanio, Thomas Smith. So a lot of familiar names and a few new ones. Welcome and thank you for joining us. So let's take a look at the S&P 500 SPY ETF. We've been missing out on a lot of the profits in this rally, but we also took a lot of the sting out of the recent crash and in December. So these portfolios all launched right around this point in time. Because we did the covered calls, we didn't see very much drawdown. Did see a little bit, but not a lot. And on the same note, because we're doing the covered call, we did not capture all of this run up, and that's exactly what we're trying to do with our portfolio. So let's take a look at what's going on. Our portfolio, if we pull up the trade alert, we'll show you the true profit. And so I'll pull that up. This is the screenshot after covering the position and then prior to writing the new covered call. So it's captured a 6.7% gain during this very volatile time. And again, our goal is to assist retirees in generating retirement income for the rest of your life. So we're much more concerned about losing money than making money. And so today's trade was yet another defensive trade. We could have made a lot more money in the last few weeks if we weren't writing covered calls at all. But let's talk about why we do like the covered call and how much money we can make by just doing this very repetitive trade every Monday, Wednesday, Friday. So in general, we try to collect $100 for every 100 shares of the SPY ETF we own 3 times a week, 52 weeks a year. So that's a 0.35% return on our capital, and that multiplied 156 times is about $15,600 a year of income, and the startup cost is to own 100 shares of the SPY ETF is around $28,000. So that's a huge return. Today's trade does not try to capture $100 per covered call. Let's take a look. If we only go for $50, which is what today's trade does, we're looking at a 0.17% return on investment. If you do that 156 times a year, you still generate a very handsome return. And without compounding your profits, it's $7,800 a year of income against our initial capital. So let's look at why we're playing it safe at this point in time. And the chart I like to pull up, most of our readers were just kids during this period of time, or perhaps getting ready to go to college. From 1965 through 1982 was a period of negative returns in the Dow for 15 years. And so this is a much bigger concern to retirees who want to generate retirement income through the stock market. We can't let our portfolio just sit there and have a negative return for 15 years. And the bad news is most of the top hedge fund investors in the world, from Ray Dalio to Druckenmiller, just about anybody you ask who's not biased to the long side of the stock market, is anticipating such an event, that we have negative or flat returns for a very long period of time, which is hard to believe when we're sitting on a SPY ETF that's flying straight up right now. So let's dive into today's trade, talk about the economics of that trade, and what we're looking at for the next few months. So we covered our covered call from Wednesday. We took a loss on the covered call, but our underlying asset went up in more value versus what we lost on the covered call. So again, if the market goes up, we can never lose with this strategy. We may make less than everyone else, but we won't lose. And again, our only concern is if the floor falls out and the stocks start to all collapse. So that's our biggest fear, and why we will consistently be playing it safe. And so this is an example of how we can predict a flat or down move in the S&P 500 and still make money if it goes up. So let's talk about this. We are looking at the current trade, and what I want to point out is when I wrote this covered call, it was trading at 287. And by selling to open the April 5th 285 covered call, I'm agreeing to take a $2 loss and 6 cents at that very moment in time. Now, why would you do that? That's because we're taking the 256 credit. So if we're wrong, the worst thing that happens in terms of the market goes up is we miss out on potential profit and we collect our 50 bucks. We get assigned, we get that guaranteed 50 bucks. If the market goes flat or sideways between now and Friday, we've generated a higher return and protected against the downside up to $2.56. So let's take a look at why we're being a little bit bearish despite the market clearly just betting up, 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 up. So if we look at the volume today, there is a huge skew in volume to the upside. And if you actually expand that, there's people betting this will go way above 290 even by this Friday. So the market's extremely greedy right now, over exuberant, and just betting straight up. And why are they doing that? So let's pull up. So it's a very concerning situation when the bond market's yields drop at the same time as a US stock market going up. So it's really supposed to work the opposite. If stocks go up, the rates on treasuries should go up, and vice versa. But we're seeing the exact opposite happen. So that's why I'm becoming very skeptical of this current rally and expecting that we are going to see the TLT sell off, which it already has begun, and I believe the S&P 500 will follow suit. And so that's why we're playing it very defensively at this current time. Now, what we're not doing is buying call options on the VIX, which is a more aggressive way to protect our portfolio. But we want to. I would love to do that, but not until we see real signs of a crack in the market. So right now we're taking the risk-free way to generate retirement income and provide our portfolio a small amount of protection against downside. And the reason we're so concerned is that all of the central banks have come out at once and become extremely dovish and stated that they're scared of a global slowdown. So it really doesn't make any sense. If the central planners are scared of a recession and are becoming uber dovish, and we can see that all the smart money is not buying into the stock rally, we really just left with corporate buybacks and central banks propping the market. So certainly I'm skeptical, and that's why we're taking half the potential profit on our covered call trade as of the last several trades. And the good news is that still generates a great return even if we did that for the rest of the year. Not that I expect we'll do that for the rest of the year, that's just the case. Meanwhile, on our other trade at the TBT, we can see that the rates are rising. This is an inverse of the 20-year Treasury. And so if I'm correct, the big rush into the short end of the Treasury is about to get sold off. Rates will jump up, and this will put some pressure on the stock market, which has literally gone straight up since the day after Christmas, or the day before Christmas. So that's what we're expecting in terms of the relationship to the bonds and the stocks. But let's take a look at some other interesting news. Very odd event. Everybody's been following the spike in Bitcoin, if you're into Bitcoin, and everyone wanted to know what that was all about. It looks like it was a short squeeze over at the BitMEX futures, which I think is going to be a similar situation in the U.S. Treasuries. I think a lot of people are speculating that the Fed was going to drop rates, and that there's so much money flowing into that when the big guys who've been pitching this since December start to sell, and I think they are right now. I think we're going to see a similar squeeze in the bond market. So there's just a huge liquidation event at BitMEX that caused this huge spike in Bitcoin. So definitely on alert as to why exactly they got so scared to get out of their short position so quickly. And I guess this may have something to do with the futures market removing Bitcoin from the CBOE. So that was a questionable moment this week, and some news is finally coming out related to that. The big push in the stock market that's been pushed through Bloomberg and other, CNBC, is that the Chinese economy was starting to revive. And so you can see this red line right here bumping up. That's all the excitement that's being hyped through the markets right now. But you got to remember, they did push $1 trillion to their economy, which primarily hit the large cap stocks, which we cover with our FXI and the emerging markets ETF. But when we look at some other data, it's not so hot around the world. Let me get to credit impulse is still negative in China. Other Asian countries' PMIs have not recovered like the Chinese has. The surprise index is really just dropping all around the world. And so now we can get a feel for why the central banks are so scared right now. There is deteriorating data. We've got slumping car sales. We have corporations revising their earnings down. And so my expectation is that the news flow is going to dramatically change in the next 4 to 8 weeks, and that's why we're playing it defensive at this moment. Here's the City Economic Surprise Index, and you can see the SP 500, or actually the World Index, has completely gone off track relative to the economic data. And then meanwhile, we now have Trump threatening to shut down the southern border. So there's plenty of fears to be worried about at this point in time, and that's the basis of our slightly defensive play today. I'll take a quick flip at some of our other portfolios and then open up for Q&A. If you guys do have questions, go ahead and start pouring them in. We now have 15 people in here. Let's see, Steve, welcome. L. Tuck, welcome. New member. We have a free trial who joined. Ed Smith, welcome, welcome, welcome. All right, so back to our portfolio, just a quick overview. We have 2 strategies we teach in our basic membership, which is published Monday, Wednesday, Friday. Trade alerts right at 11 Eastern with the video and written version, followed by the live webinar. And there's been some confusion for folks following our TBT trades. So in the basic program, we have two very correlated assets that are really tied together. And for those of you with less than $30,000 capital, you can't follow our SPY strategy. So that's why we offer the TBT strategy. And so the big bet on this is that we are in a period of reversing a 30-year bull market in bonds, and are going to just reverse course back towards what we saw from the 60s through the 80s. And so this is a big prediction of Jeffrey Gundlach, who's touted the new bond king. Now, we're not just outright holding the TBT and allowing for our portfolio to have huge swings in value. Instead, we're, again, muting the returns by doing the covered call. So what does that mean? And if there's drawdown, we'll see less. If there's upside, we'll also see less. And so what's more important is we feel like this is a security that we can accurately forecast in general the long-term direction. And when we can do that, doing the covered call strategy is a very effective way to generate a consistent income. And so the TBT, after we cover last week's position on Friday, we'll have a very similar return as our current, what we call rich man strategy, trading the SPY. So there's pros and cons to both. Some people do choose to alter their settings. So if you wanted to follow both programs, you could simply reallocate some of your cash up here to the various sectors. So if we wanted to take a little bit off the SPY and go a little heavier on the TBT position, we could do so by just altering this up here. And what you'll see is it's going to now issue a trade alert to sell 182 shares of the SPY ETF and purchase 1,621 shares of the TBT. Now we're only dealing in increments of 100 because we want to be able to protect our assets through the covered call. So a lot of people do choose to do that. In our model portfolios, we're keeping it separate. We have the SPY trades in this spreadsheet, which you can click to in every email and go through it. And then we have the TBT trades in this spreadsheet. And now this did write a very defensive covered call on the 29th, expiring on the 5th. And that will be rolled over Friday. So that profit will drop probably very close to the SPY one once we cover this position. Now, for those of you who do have a lot more capital to put to work than 30K, you might be a little more interested in our Tuesday class. The basis of the Tuesday class is to look at what's under the hood of the S&P 500, pull out the most important companies, and then build the right ratio between each company, and you can get a much higher covered call return. And so you can see this one's sitting at a 12.6% return. There were a few defensive plays in this week, primarily on Microsoft and Apple. So it'll probably be a little bit less when we cover these next week. But we did catch a nice win on Facebook. And by looking at the option market, we predicted Facebook would go up, and it's one of the top performers today. So this portfolio does take $150,000 to build, and it's really the top positions in the S&P 500 and the NASDAQ, stripped of certain companies that cost too much per share. So we've stripped out Google and Amazon, as those alone would be 6 figures to own 100 shares. If you look at the Berkshire Hathaway company, is one of the top positions in the S&P 500 SPY ETF. Well, if you boil that down, its top positions that represent almost half of its equity portfolio is Apple, Bank of America, and Wells Fargo. So we've taken out a lot of the small companies, the S&P 500, and really just focused on the top positions, and that's what this portfolio is composed of. Steve asked, how long has this portfolio been open? All of these were opened at the same time on the week of December 12th. And so this portfolio is traded on Tuesdays only. We roll the positions over every Tuesday. Some of the downsides to this strategy is that we can't alter where our covered call is as often as we can with the SPY trade. But the benefit is we're only trading it once a week. So we'll be a little more quick to add the hedge to this portfolio, considering we only trade it once a week, versus the SPY ETF, where we can be pushing our covered call lower and lower, if need be, every Monday, Wednesday, Friday. So for those of you who prefer to trade once a week and have 150,000 capital, this portfolio is very attractive. And for those of you who prefer to keep it simple, you'd rather have one security and you don't mind just trading for 3 to 5 minutes every Monday, Wednesday, Friday, then the SPY trade might make more sense. Teresa wants to know if we hold the covered call through earnings. So we certainly pay attention to the news flow of these individual companies, for sure. But again, our audience is not a growth story. We're not trying to buy and hold for the next 30 years. So we can't afford to take big losses. So our product is really nailed down to folks who are between 50 to 80 years old. They want to protect their assets. They want to generate a high level of retirement income, and they want to have something they can pass on to their kids. So that's what this does. This gets the best securities in the world, bar none, and then always has a covered call. So no, we're not going to try to hit a big gain on a nice earnings. Now, the good news is if the market thinks there's going to be a surprise in their earnings, the option premium will go up as people start to buy lots and lots of call options on that. So certainly we do benefit from that type of news flow, but in general, we're going to reduce losses in terms of downside, and we're going to make less on the upside. So Mark's asking, why not buy some puts on the SPY if we're going to get a downturn? Yeah, certainly. So the problem with buying options, if anybody's done that for very long, is that they almost always just lose money very rapidly, and so very cautious to hedge, because we have a free hedge, we have a risk-free hedge with the covered call, and because we're reacting so quick, we have a unique audience that's willing to check in 11 Eastern every day, or at least Monday, Wednesday, Friday if you're on the beginner level program. And so we're going to wait for the market to actually show signs of weakness before we'll jump into basically a losing, a trade that we're against the house. The house is always tilted to the long side. So when you want to bet down, it's very difficult to capture profits from that. Now with the covered call, we can do a risk-free protection trade, which is what we're doing today. So certainly I would love to buy some calls on the VIX and eventually buy some puts on the QQQ. But I want to wait until the market's actually starting to move. Now, if you had a lot more money, you'd have to predict the moves before they happen. But our clients are not in that situation. Most of our clients have between $30,000 and $1 million, and they can easily get in and out and go with the momentum of the market. So in terms of predicting down moves, I don't mind doing that with the covered call because we have very little to lose. We're missing out on upside potential. But if I tell you to go buy that VIX call option, I need to have a lot of certainty that the trend has already begun. So I'll be looking not only for some volatility in the S&P 500, but for a change in the news cycle that's going to help scare everyone into selling. And you'll see when the market is ready for a sell-off, the banks push plenty of bad news through, and the whole tune of the talking heads changes very quickly. So because our clients aren't, checking their accounts once every 3 months. We have the luxury of being able to quickly react to changes in the market conditions. The last class we have is emerging markets. So if you're familiar with BlackRock, I think it is the biggest asset manager in the world. Their big news is they are pushing huge amounts of capital into refocusing their energies to build out portfolios in and for the emerging markets. So this is the big trend of probably the next 30 years is going to be the growth story in China and all its partners. So the key partners are South Korea, India, Russia, Brazil. And so this portfolio, we currently recommend at most 25% of your capital being allocated here. This portfolio costs $50,000 to build. It has exposure to the metals in this area. But again, this is not a growth strategy. If you want growth, it's a great portfolio as is. You would just ignore the covered call. So if you are looking for some growth in your assets, the best thing to do is take our trades, look for the hedges, and do not take the covered calls. If you want to protect your assets, generate a consistent return that adds up to a big profit, if you do it over and over and over again, then this is a very high yielding covered call strategy in the emerging markets. So this class again is on Thursdays, and it only trades on Thursdays. So one big thing about our product is we have a set time to trade every day, which is 11 a.m. Eastern. Comes out with a video, a trade alert, written format, plus you get a copy of our spreadsheet to manage your own trades. That is then followed 2 hours later with a live Q&A webinar, which you guys are all on. So what we end up with is a very easy to follow program that, quite frankly, is a lot different than most products out there. In my experience, which was for the last decade, was finding the best traders in the world with the best pedigrees that ran hedge funds and met all the presidents, all kinds of crazy stories. They always felt to provide value to the market, they needed to beat the returns of the benchmark, which is the S&P 500. And some of them could do it. They could actually do it, maybe not for a long period of time, but at least in their spreadsheet, it looked like they were. But what was happening with all our clients? They were not able to get the trades, react to them, and understand what on earth to do. How much of their capital should they put into each trade? So a lot of these things that our spreadsheet takes care of, we're just not clear with almost any other advisory service out there. Beyond that, getting the same prices was almost impossible because they're trading who knows what at who knows which time. And so our product really is trying to do the opposite of that. We're actually trying to mute the return of the stock market, pull out the option premium of people who want to speculate that the stock market will go up forever, and really protect our assets. So we'll be actually more happy to have a smaller return in a bull market, a better return in a flat market, and of course a positive return in a down market. All right, so let's see what other questions we have. You guys have any other questions you want to plop through here? Okay, seems like we got a pretty good grasp of the current trade alert. Is there anyone out there who would like me to pull out their spreadsheet and unmute your mic, and we'll talk out loud, and I'll start filling out your spreadsheet and optimizing it for your personal goals? I'm sure I'm going to unmute Jerry. He's always vocal. Mark, I'm going to unmute you. If anybody else would like to speak. Jerry, I got you unmuted.
Yeah.
Ed has a question.
Let me type my email address in there.
Okay, I got a quick question. Ed says, what do you do for downside protection? Sure, so let's cover that really fast. Okay, so in today's trailer, we have a certain amount of downside protection, and that's about $2.56 worth of downside protection between now and Friday. And on Friday, we will add a new measure of protection. And so what's interesting about this particular trade is that we have a risk-free way to protect our portfolio from a limited amount of downside protection and generate a very nice return. And so if we look, when I wrote this covered call, it was trading at 287, and I'm agreeing to sell my shares for $285. That's an immediate $2.06 loss, but that is offset by the $2.56 credit. So if the market goes higher, the person we sold this call option to did great. And they've been doing great for 3 months straight. So they are getting more and more confident that they can keep buying call options and continue to make very outlandish returns in a short period of time. But what if that stops? What if we just go flat? They lose all their capital. We keep the entire $256 credit, and we also keep our underlying asset. So this is our primary method of protecting our capital, and that's by writing an in-the-money covered call. Now, is it possible the SPY ETF could crash $10 between now and Friday? Sure, it certainly is. And so that is definitely a risk that cannot be necessarily protected with a $2 in the money covered call. Now, if we had written a covered call that was $10 lower, let's see what that would look like right now. So what you're going to see is that the more protection we try to purchase, the less reward we get. So if I were to go, let's say, just $7 down, or rather $5 down, we're currently trading at 287.24. I could get $5 of protection by writing the 282 covered call. And after I take the loss on the underlying and accounted against the credit, we would then be sitting on a $22 profit. So if we were even more scared, which as the market starts to sell off, I will drop this strike lower and lower and lower, more aggressively. We reduce our profit if the market goes up. So if we wrote this and the S&P 500 went to 289 by Friday, most likely we get assigned, we have a $22 guaranteed profit. However, if it goes flat or down, we will keep our underlying asset and be able to buy back that covered call for a huge profit Friday. So that's our favorite way to protect against downside risk. Now, that only works to a certain amount of protection, which will most likely be up to $10 maximum in a 48-hour window, which is rare for it to do that. So what can we do on top of that? We can buy call options on the VIX. And so if we look at some of the option chains for the VIX, we can see where people are predicting that will go. And right now, the short volatility play is massively being overdone. This is just like the bull bond play that I believe is about to take profits and snap the opposite direction. So we can see volatility has a huge amount of put option volume and open interest at the 13 to 1250 level. So what happens when everybody has to cover those positions? They have to buy the VIX. So this in itself could cause a short-term snap in volatility and a pullback in the S&P 500. So at some point, if we were really concerned and considering the format of our product, we have short-term protection every Monday, Wednesday, Friday that's constantly being maintained and moved around. So what I would do if I was really concerned about a longer lasting pullback or a sharper pullback, the first step would be buying a call option on the VIX. And so this is the farthest out we can go, which means the least work in terms of having to manage this position. And considering we already have the short-term protection, we're really looking for a long duration call option on the VIX to help give us a little more protection. So if and when we do see some violent moves in the underlying S&P 500, that's when I would put the call option trade alert into our portfolio. And it's going to have to represent around 9% of our portfolio to offer any amount of protection relative to how much money we have in the S&P 500 SPY ETF. So it'll be a large position in the VIX, and it will be as the VIX is rising. So we're not going to try to predict the volatility spike before it happens. In this instance, because we have the covered call protecting us in the short term, this will wait until it looks like the momentum has really changed. So that's play two. Play one was a covered call. Play three, we're not going to buy the SPY puts. We're going to buy the QQQ puts. So if the SPY goes down, typically QQQ goes down even more. Now with this one, I'll be the most reluctant to put on. This will be the January 15th, 2021 most out of the money put option we can possibly find volume for. And so somewhere probably right around here is where we'll be getting another hedge in our portfolio. And this will be after we've seen a serious, well, let me pull up that ticket one sec. So again, buying options is, okay, so Mark says, how do we get the 9%? So if we have 9% of our portfolio hedging 91% of our portfolio, we're going to have to capture a pretty considerable gain on the VIX trade for it to really provide enough support to reduce the losses. So we're looking at potentially a 50 to 100% return on the VIX trade against 90. Oh, Steve is still holding on to some $35 puts from 2017. Yeah, so that's a great point. So people have been calling the stock market crash for the last 5 years. The central banks continue to inflate the bubble and print more and more money. And of course, Steve also took a lot of bullish trades during that same period that I think did very well for him. So yeah, we're going to wait until something really cracks before and he says absolutely. So yeah, the strategy we were doing with Steve back in 2017 was much more advanced. It was doing spreads and things of that nature, but not like this. We didn't have the covered call to constantly guard our position. We couldn't just easily readjust our positions, and we had no way to generate this consistent return. And he says he's not complaining. Oh, I didn't think you were, Steve. Just so that the people listening didn't think I was just having you throw away your money on those out of the money puts. So that's really our 3 lines of defense. We have a 4th way to profit from downside risk. So there's 2 main forces that I believe are keeping the stock market alive, or rather keeping the liquidity high. Okay, number 1 is obviously the central banks. They're not allowed to buy securities directly, but if they keep rates low and they buy treasuries, that takes a lot of pressure off the bond market, which in turn pushes capital to stocks. So that's an indirect force that is very positive to the stock market. So that's one, and right now they are fearful of a global slowdown, so they're not putting pressure on the market in a negative way themselves. Now they are telling us there's a lot of problems abroad, but at least they are currently supportive of the stock market. Next is we have corporate buybacks. So the corporations are making tons of profits, and they're also borrowing record levels of money, and they're buying their own stock. So this ticker will do well when corporate credit cracks. So if we think that the corporate buybacks is really the big dilemma for a stock crash, well then first corporate credit has to tighten. So if the SJB starts to rise, that could spell big trouble for the S&P 500. So at some point, we may start allocating capital to this ticker. We would not be writing a covered call against it because once again, this is designed to basically predict a stock crash before it happens and allow us to profit from that. So that's really our 4 key ways to protect our American-based portfolios. And if we go back to our 2 American strategies, or rather 3, the SPY ETF has some big benefits. It's super liquid, and we can adjust our covered call Monday, Wednesday, Friday. You can't do that with any other security in the world. So if you're really concerned about protecting your assets and you're willing to trade 3 times a week, very hard to beat what the SPY has to offer. If we go to the high yield strategy, we could be covering our trades, multiple times during the week, but in this product, we're not. This is designed to take a higher level of risk, to generate a higher return, and to take less of your time. So this program only trades on Tuesdays. Mark's asking, how do you pick the out of the money put option? Or what strike, what open interest level? And so, yeah, so when I first got into this, believe it or not, this fellow had predicted the 2008 crash. He had actually managed to get some penny out of the money put options on the QQQ, which clearly don't exist today. And he had shown me his brokerage statements with anywhere from 10,000 to 30,000% return. So he's taken $10 to $20 bets and turning it into like 10 to 30,000 bucks, and he made a few $100,000. And this is what first got my interest in the stock market. And so really what's going to happen is as the price of the QQQ goes down, you can just look at the trading prices up above, and let me get to the right one. Okay, so right here. So we can see as the QQQ goes down, these prices are essentially going to slide this direction. So if the QQQ drops somewhere between 10 to 20 bucks, these could jump from 39 cents to $1. If we put this trade on right now and the QQQ dropped about $20, you could predict that this price would jump towards that range. So we won't be too concerned about the open interest. We're mostly just going to look at the farthest out of the money we could possibly buy. And that's because we're using this for the worst case scenario with 1% of our portfolio. So this position will only be at most 1% of our portfolio, and it's truly designed to capture an enormous drop. And we will hold that position for potentially at least half of its duration. So we're looking, if we saw a crack in the markets today and jumped into this, say next week, we might not be selling this till sometime in 2020. So it allows us to have the confidence to continue writing our covered call, to generate income through all market circumstances. And this would be the last measure of defense that we would add to our portfolio. Most likely, I would want to see either the central banks getting very overconfident and talking about raising rates again, and the stock market already breaking into new highs. We've got China deal done. Everybody's super complacent. The market's just breaking into new highs. Something of that nature would want me to put on that kind of insurance, or the opposite. Suddenly it's clear this China deal is not going to happen and they're going to raise tariffs. That would be a nightmare. So either one of those conditions would most likely result in me recommending a 1% total portfolio in the furthest out of the money, longest duration QQQ put. Now, in terms of the VIX trade, we only get 6 months of protection if we expect to sell within half the duration. So we really only get 3 months protection with the VIX. So that one, again, I do want to see something to give us the right indication that it will switch directions and continue. And that's a bigger position at 9%. Can't raise rates, it will cause a crash. So yeah, the Fed's getting boxed into a corner. We'll see how they play it. But yeah, that's the basic plan. In the long run, we know they will continue to print money until they can't. So it's kind of my short-term look at this. All right, what other questions we got out there today? All right, guys. Well, I guess we'll wrap up today's webinar. I hope everybody enjoyed it. We have another one tomorrow. Tomorrow's our emerging. Oh, let's see. Jerry says, "Do I want to?" Oh, post your email one more time, Jerry. I'll pull it up. This is interesting. Mark says, "I think this strategy makes an enormous amount of sense and success." Yes, it's a good strategy for sure. Let me pull up Jerry's email. I want to show you guys that you can actually. This is not like your typical advisory service. Our goal is not to make you reliant on myself by any means. We're giving you the tools and the knowledge to take care of yourself, so you can pretty quickly get a grasp of what we're doing, why we're doing it, and after several months, potentially even be able to fine-tune it for better results based on your exact needs. And here's a good example, let's see, of one person in our program who's quite frankly only been in the program for 3 weeks. He's sitting on a $9,000 profit, and he's actually ignoring most of the trade alerts we've been giving out. And so how did he do that? Well, we did this together. I helped him recode the tickers, and what you'll see is this is a smorgasbord of all 3 portfolios combined, plus a little bit of his own flavor, the inverse VIX. So this is probably the most overdone trade in the market right now. And you might want to consider starting to write that covered call below the trading price to play it safe, Jerry. But you can see he's generated $9,000 profit. He's using our platform. He's managing his covered calls over here. He's slightly optimized the allocation per category, and he's removed a couple companies he didn't like. He doesn't like Facebook. We took Facebook out, although Facebook's doing very well right now. But you can see he's sitting on a 5.8% return, and he should be very proud of himself. He did almost all of this completely on his own.
Thank you. Yeah, I was going to lower the delta on the VXXB on this next turn on Friday.
Okay, great. That's great. Okay, Steve, yeah, let me jot down your number. I'll give you a call after, okay? So yeah, your portfolio is looking great. My only concern is that I do think we're at some point going to see a VIX explosion, and of course, holding the inverse would mean that the underlying asset would drop in value on this one, and at a much faster rate than the rest of your securities. So if you own 1,000 shares of that at 28,000, you might give up your 10K profit. At least in a short term, maybe it comes right back down, right back. But that'd be my biggest fear for this allocation is that inverse VIX is a overtraded play that really probably can't go too much lower. Let's look at the VIX.
Yeah, actually, I was thinking at times of possibly just taking off the covered calls in that case.
So yeah, I think yeah. Let me pull that up. So this is a interesting ETF that was created to do a trade that option traders do on the VIX. I think Steve will probably we'll remember one of our favorite things to do is simply wait for the volatility to pop and then short it with a spread. So they created an ETF that allows you to do something similar to that. And so yeah, I'd just be very careful that this could blow up on you during a liquidity event. So we got some questions popping up. Mark wants to know if Jerry's outperforming my results. Yes, he is. He is outperforming. But again, I'm not trying to outperform. I'm much more concerned with protecting.
What's your main concern on this VXXB? Because I hear a lot of caution in your voice when you're talking about it.
Yeah, so I think the VIX will spike higher and cause that underlying ETF to drop in value. So right now you have 30,000 bucks in that ETF, and I'm scared it might, for a short period of time at least, lose up to half or more of its value. So if this were to spike like it did in December, or even just to 26, I believe your underlying asset would drop in half.
No, it's the opposite. It would go up. Like if we go back to like the last week where it ran up to 33.
Oh, okay. So this is the same as the VIX. Okay. Yeah. Well then, yeah. Sorry, I misunderstood. I thought you said it was the inverse VIX.
No, it's more inverse of the
inverse SPY. Okay. Well then, in that case, I would just take off the covered call.
Yeah, that's what my thought was to take off.
Okay. Yeah. My bad. I wasn't familiar with this ETF, so it's been confusing me. Okay. So let me relabel your spreadsheet so it's not misleading.
Okay.
Okay, so yeah, that's been a great play. He did get a lot of his profit on that VXXB, and so that's why it's outperforming. But that's definitely a riskier asset. It's not really owning anything. When we own Microsoft, we have a real company with profits that will go for until the sun doesn't shine. Whereas the VIX is really a speculative investment. Okay, Ed says, doing the SPY trade, what would be a reasonable return on investment for the year? Yeah, our target's between 20 to 30%. What other questions you guys got? All right, guys. Well, it was another great webinar. We have another one tomorrow. So I will post this webinar recording to our webinar recording page right after this. And we will be doing the emerging markets trade tomorrow. So thank you so much for your time. And I look forward to another trade alert tomorrow.
Thanks, Jason.
Thanks.